Hi from the Private Banking Congress in Hamburg. My name is Tom Libbert. I'm editor at the Private Banking magazine, and I have a visitor from London, Jonathan Waghorn. Welcome in Hamburg, welcome at the Private Banking Congress. And we're talking about sustainable energy and the sustainable energy strategy that you are managing at Guinness Global Investors. One thing to add is that this strategy is in a normal fund, and you have it also in an active ETF.
That's correct.
So this is quite uncommon, but it's the same strategy. So this is probably important to notice. But let's start about this strategy and the sustainable energy in special. Temporarily, there was a big hype around sustainable energy. We've seen it at the stock markets. The ETF left the benchmark quite wide behind. The market then corrected from 2021, I guess, and now the performance and the strategy also lowered a bit. So what is behind the recent correction, or how would you call it?
Sure. Yeah, we've seen a big cycle. So 2019 and 2020 were very, very strong years. If we think about the drivers behind 2020, especially post-COVID, we saw the EU Green Deal. We saw the introduction of an infrastructure bill in the United States that became the Inflation Reduction Act. And we saw China move towards a 2060 net zero target. And all those were associated with COP25 that was in November of that year. So there was, as you say, an awful lot of enthusiasm. I think growth expectations for our companies got ahead of themselves. I think valuation got ahead of itself as well, around the whole sort of ESG theme. Looking then from that point until now, we've seen a number of factors. We've seen inflation, so post-COVID inflation in raw materials especially. Many of our companies are manufacturing companies, so they have to take on that raw material inflation. We've seen interest rate increases, and that affects the purchase of an electric vehicle, the purchase of solar cells as an example. And we're now starting to see those come out of the system, and that's starting to be a little bit more positive. But the impact of those then was to reduce the earnings growth of our companies, reduce the valuation premium, and we've essentially done a big round trip. So now we look at the valuation of the fund at a 20% discount to the MSCI World. We're back to where we were at the end of 2018. Pessimism is running pretty high here in what should be a very, very long-term and attractive theme.
Okay, and if we're coming to the portfolio, you have like an investment universe. I think you said like around 250 companies. 30 of them make it into the portfolio. What about these 30 companies, and why are they equally weighted? Because this is also one thing you told us.
So the Guinness house style is to build a universe, to look at all the companies that could potentially make it into the fund. And we screen those, we monitor those, and that ultimately drops down into our portfolio. So that process is a two-stage process. We do top-down work. We think about the macro drivers of sustainable energy, of energy as a whole, incidentally. Solar module prices, wind turbine prices. Let's look at the price of renewable electricity. And let's assess which sectors or which areas of our universe are well placed. And then from a bottom-up point of view, we do detailed financial modeling and the screening of the universe that generates ideas for us, and it gives us a good view on valuation. So ultimately, with a value-oriented approach, we're trying to pick the best names to go into the portfolio. The Guinness style is to run concentrated portfolios in an equally weighted manner as well. So what we're trying to get there is good concentration, i.e. if a name goes into the portfolio, it makes a difference. It's not 20 basis points and has no impact at all. It's good in terms of risk control, so we never have a position that is too high. We're always regularly rebalancing to some degree. But we're mindful of the fact that we operate in quite volatile markets. So sometimes we will allow things to run just a little bit further and make the most of that momentum. That's a process, it's a thinking that's worked very well for Guinness over the last sort of 25 years or so that Guinness has been running that style.
You mentioned valuation, and we're standing here in the harbour, so if we look outside, we had some strikes here in the harbour.
Okay.
Which is also based on sustainable energy and prices of energy. So I think this whole topic is quite emotionally also here in Germany. So how does that affect the prices, the valuation of the sector, like politics or something like that?
Well, you think of the cycle that we've gone through, there's clearly been emotion within all of that. If we think about sustainable energy as a whole, the driver behind it for us is economics. That's the key thing. That's what myself and the team are trying to worry about. Where is the most economic? Where will we see the best growth? And at the minute, renewables are at the bottom end of the cost curve. So it is very sensible that they will grow and will come through. In addition, then you've got carbon emission reductions. That's an emotional subject. We have pollution, not so much emotional. That's a health subject. That's very, very important indeed. And we have energy security as well. So those are other factors that all play into this debate. But ultimately, we're looking to try to find the best economics that we can, and we're quite rational investors. We try to look through the emotional hype, pick some good quality companies well exposed to the theme, and to try to avoid some of the crazy story stocks or the very exciting stories where ultimately companies aren't delivering real revenues or real earnings, and therefore they're very difficult to value. So typically a more pragmatic approach and trying to remove some of the emotion.
Yeah, pragmatic. Are those companies that you have in the sustainable energy strategy, are those also green, as you would say in ESG terms, for example?
Depends how you define green, but from my world, I'm thinking about carbon emissions. I'm thinking about a strategy here that is helping to reduce carbon emissions or investing in companies that are doing that as part of their day-to-day job. But we have a phrase in England that to make an omelette, you must break some eggs. Okay, so no company is carbon-free. Companies may well be making solar modules or wind turbines that will ultimately help to reduce the amount of carbon emissions that would otherwise have gone into the atmosphere, but they also emit carbon in the manufacturing process. They consume energy and they consume raw materials. So the process here is something called Scope 4. And Scope 4 is a carbon emissions avoided calculation. For 6 years now, we've run an impact report under our own calculations to assess the Scope 4 of our portfolio relative to Scope 1 and to Scope 2, to try, as best as we can, to put some quantitative analysis to those numbers. And our portfolio as a whole has a much larger Scope 4 number than it does Scope 1 and Scope 2. Okay, so there is a good balance between the two. Carbon emissions, we think, are avoided as a result of what the companies do, but carbon emissions also happen as a result of that process.
Yeah, okay. We spoke at the beginning about the large performance divergence on this topic. Let's look in the future. What is happening next?
Sure. So pessimism today, I would say, is very, very high indeed. If we think about the valuation multiple that we're going through at the minute, we're a 20% discount to the MSCI World. We look at our portfolio, we can see about half of our portfolio is doing very nicely in good areas that are performing well, and half is doing quite poorly at the moment in sectors that are finding it tough. Areas that are doing well, electrical equipment, energy efficiency, benefiting from things like upgrading of the grid, artificial intelligence, computing, those companies doing very nicely indeed as we move towards electrification. Companies involved in electric vehicles finding it very tough. The auto market is under pressure at the moment, and companies involved in solar and wind manufacturing, again, a similar theme. But we're starting to see signs of bottom of the cycle behavior, and that's good. That means hopefully they will now start to turn. Predicting the future is very, very difficult. I'm not going to try and do it here, but I'm telling you, our companies, when we look through, we see an earnings growth that is nearly double that of the MSCI World, but they trade at a 20% discount. Now, for me, that doesn't make sense, but I can't tell you the timing of when that changes. But happily come back here next year, the year after, and try to update you on the topic.
Yeah, we'll do the checkup then. Okay, perfect for joining us. Thanks for joining us, and yeah, we see each other probably next year and on Private Banking Magazine. Thanks for listening and watching us.